Hello everybody, welcome to Nexa Mortgage. My name is Vance McKim and I'm a loan officer here at our Glendale Arrowhead office. And today we're starting our series of informative videos on mortgage lending, what you need to know, and how to buy a house. Today we're talking about pre-qualification letters and what they're good for, why you need one, and what it takes to get one. So basically we start off by saying your pre-qualification letter is what you need to take out with your real estate agent to look at homes. And the reason for this shows to your real estate agent that you're actually qualified to buy a house. You have the finances in line, your credit's good to go, and you're basically not spending time running around looking at homes that you're not qualified to buy. Secondly, for the sellers of a house, if you decide to put an offer in on the house that you find that you want to buy, basically they want to see that you're a qualified individual, that they're going to accept your offer over someone else's because they think you're a better qualified candidate. Today, we're talking about pre-qualified letters, and you might hear the other term pre-approval letter. And really a lot of this is the same, and it could be just a terminology that's different between different lenders. Different banks may use that term, but basically a pre-qualified letter is just looking at your finances, looking at your income versus your debts that you spend out. That's why we look at your credit report. And just to see that it is in good standing, that you're not late on payments. And basically with those two factors, you can figure out what your monthly payment would be and how much house that qualifies you to buy. But in a nutshell, your credit is your credit worthiness, your FICO score. Those usually range between an 800 at your highest, down to in the mid fives, even lower, just depends on what your credit's like. But for people who are looking to buy a home, you would want to have a 580 credit score or higher. Just depending on the different programs that are out there, they require different FICO scores. So you've heard that yes, you need to have your credit pulled. What we try and do is what's called a soft pull. Instead of all three credit bureaus being pulled at the same time, we just pull one. We just want to see kind of how your credit looks, and just that gives us an idea of what to look at before we move on. We'll look at the last 12 months, make sure that there's no late payments on any of, say, credit cards or a car payment, anything along those lines. And basically, everything is going to go in kind of pairs of two. So we want to look at 2 years credit history. We'll want to look at 2 years worth of your taxes, just to show that how much income you've got going in. We'll also look at 2 months bank statements, just to show that you have the funds there, basically to put a down payment on a house, or that you have some reserves to be able to make those first few payments moving into a new house. So basically we want to look at your debts that you're paying out on a monthly basis, and it's not that, say, you have a $30,000 car, but you have a $500 car payment that goes out every month. Now we'll take that, add that to what the payment on a new house would be, subtract that to what your monthly income is, and we generally don't want to be over the 50% range, meaning that all your debts going out every month do not exceed half of what your monthly income coming in is. And basically that's going to tell us this is what you qualify for as far as a monthly house payment, and then we know that you calculate that out, that gives us what your total cost of buying a house would be based off today's interest rates. But the thing you need to understand about the house payment is it's a combination of the interest that you're paying, the principal that you're going to be paying, the taxes on that house depending on which state or county that you live in, whether you have mortgage insurance. It also includes HOAs, whether this house is in an HOA payment or HOA zone or not. The monthly payment would be calculated into this, and then whoever you have your homeowner's insurance with, whether that's Geico, State Farm, a variety, it really doesn't matter. Whatever the quote is that they're telling you your homeowner's insurance would be included in that as well. But basically what we would want to do is go in, look at your documentation, look at your credit, 2 years bank statement, 2 years tax history with W-2s. This is all the documentation you would need. 2 months bank statements, 2 forms of identification, and basically we have to verify that it's you, and 2 months pay stubs to show what your income is coming in. And this verifies everything. So what we call is mattress money, that you're not just telling us, oh, I have this much money. We actually have to verify that. Federal standards dictate that we have to do this. So those are kind of the items that you would need to get a pre-qualification. Once we have all those, we can run the numbers, look at everything, and then write your pre-qualification letter so you go out with your real estate agent and find that house. From all of us here at Nexa Mortgage, we hope you enjoyed this video and found it informative on your next home buying opportunity. Feel free to call us anytime, and we'll talk to you soon.